Joining us now, Steve Moore, host of More Money on WABC Radio, co-author of The Trump Economic Miracle. Steve Myron, by the way, very smart guy, the new chairman of the CEA. But you heard him on that clip. That's what he told me last night. Trillions of dollars of revenues. He didn't want to put an exact number on it. So I heard that, and of course, my first instinct is more revenues from tariffs to cut taxes, which has to be number one priority, Steve Moore. Let's get those tax. You can get even lower taxes. If he's right, if he's remotely right, heck, you could take the tax rate down, the income tax, the personal rate to 15%. Make Steve Forbes happy. Have a flat tax.
Yeah, boy, do I love that idea of the 15% rate. And you're right, by the way, though, some of the manufacturing numbers and industrial production numbers came in pretty well. They looked pretty good. So I was really cheered by that. Listen, I'm going to simplify what you were just talking about with Kellyanne. A tax cut is a tax cut. A tariff increase is a tax increase. So I'm not so sure I want trillions of dollars of higher tariff revenue. But I remain pretty bullish right now, Larry. I mean, think about this. You know, Fox is reporting that there may be a deal with Ukraine, a peace deal. Don't you think peace is pretty bullish, Larry, for markets?
I do.
And then the inflation reports are coming in. Inflation is falling. That's a great sign. And I think sometime, I don't know if it's coming next week or next month or the next couple of months, we're going to have a tariff trade détente. And I think these countries are going to stand down. And you put all that together, and I think the market just explodes, and so does the real economy.
Yeah, you know, Scott Bessent was pretty optimistic, too. He said this morning on Maria, going into April 2nd, some of our worst trading partners in terms of the way they treat us have already come to President Trump, offering substantial decreases in very unfair tariffs. I mean, you're not going to look a gift horse in the mouth. You're going to say, okay, if we can get tariff parity and we get more revenues out of that, that's a good thing. I mean, maybe we should be pushing, in all seriousness, maybe you and I and Laffer and Forbes and the rest of our crowd, we should be pushing for deeper tax cuts. You know what? I mean, extensions are fine, and the no tax on tips is good. Certainly the 100% depreciation on factories, that's a new wrinkle. Maybe we should be pushing for lower income tax rates. That's what Forbes has been talking about. Those middle brackets could come way down. I mean, I think we have to be very, very aggressive here. The economy can boom like we've never seen before. People are gearing up for it. You look at the number today on production, business equipment, right? Business equipment, which is so important. Manufacturing broke a new high, finally beating Trump's one in late 2018. Yeah. I mean, we got to roll the dice here. We got to go for gold. Got to do everything.
Yeah, I want to make sure that people understand something that I didn't understand until I had a conversation with some business leaders yesterday, where I think you know this, Larry, that, you know, we did the 100% expensing in that bill you had such a big part of in 2017, and it was 100%. And then in 2023, it went down to 80%. And then in 2024, it went to 60%. Do you know right now it's only 40%? And a lot of these business leaders are saying, we're not going to invest in that. So if that keeps going down, you're taking away all of the benefit of these companies investing in the United States. So we got to get this done so quickly, because as soon as Trump announces that he's got this and we get this signed, I think you're going to see a spurt of investment, because it goes right back. I think didn't Trump say he wants to make this retroactive to the beginning of
January?
The year? I think,
no,
yes, that's huge.
Retroactive to his inauguration, which was what, January 15th. So that's, you know, look, I know it was expiring. You know, the McLaughlin brothers, John and Jim, they did a poll, and about half of people in the country do not know that all the other tax cuts are expiring at the end of the year. The individual tax cuts expire at the end of the year. The standard deduction expires. The kiddie credit expires. Half the country doesn't even know that. And I think the Trump people should be telling that more and more. It's going to expire December 31st if we don't get this done. That's very, very important here. You're rolling the dice, rolling. And the members of Congress have to get going fast. Let's do this. We got to be aggressive.
Yeah. Why isn't this done already? Frankly, I mean, it's not that complicated. You got the Republicans running the House and the Senate. I wish they had gotten it done already. The Senate and the House are still kind of talking past each other a little bit, Larry. Why don't they get on the same page? I don't know how you feel about it. I'd love Trump to just tell the Senate, pass the House bill. It's fine. It does all the things we want to do, and let this, because again, these businesses, as soon as that happens, the investment will spurt up, and you're going to see a revival. Don't forget also, now only 9% of Americans have to itemize their deductions. So we vastly simplified the tax code. If we go back to the old system, 40% of Americans are going to have to collect all those shoe boxes of receipts. This is what I gave for charity. This is all these things. But I don't want to. One thing, I don't want to bring the salt back deduction back. I hate the salt deduction. I know some of my friends in the Northeast feel strongly about that. But there's no reason.
Forbes is right. Why don't you cut the middle income brackets?
Yes.
Bring those down. That's probably, in a place like New York, believe me, that's worth more. That's worth much more. Yeah. Those things, I don't know, 75 to 100,000 goes all the way up to about $300,000. Middle income people would benefit much more than the SALT deduction. Anyway, we're out of time. But Steve Moore, thanks very much. Appreciate it.